Good afternoon. I'd like to call to order the Police and Fire Pension Board meeting for January 27th, 2026. May we have a roll call, please?
Yes. Member Curlin?
Present.
Member McQuaid?
Present.
Member alternate Murphy?
Present.
Member alternate Leduc?
Present.
Member Sue's here.
Thank you. Member Curlin, would you please read the land acknowledgement?
The City of Albany recognizes that we occupy the land originally protected by the Confederate villages of Lejeune. We acknowledge the genocide that took place on these lands and must make strides to repay the moral debt that is owed to this indigenous people, specifically the Ohlone tribe. We thank them for their contributions, which have transformed our community and will continue to bring forth growth and unity. The City of Albany commits to sustaining ongoing relationships with the tribe and together build a better future for all that now make this their home.
Thank you. That brings us to consent calendar. Consent calendar items are considered routine by the board and will be enacted by one motion. By approval of the consent calendar, the staff recommendations will be adopted unless otherwise modified by the board. There will be no separate discussion on these items unless a member of the board or a member of the audience requests removal of the items from the consent calendar. Does anyone wish to pull an item? Do we have anybody on Zoom?
No.
I would like to make a comment if I could. Online, the attachments were not uploaded, but I do see them here in the packet that we received. Is it possible in the future to have them uploaded? That can just be a question for another time. And with that, will someone please move consent? I'll move approval of the consent calendar.
I second.
May we have a roll call, please?
Yeah. Member Curlin?
Yes.
Member McQuaid?
Yes.
Member alternate Murphy?
Yes.
Member alternate Leduc?
Yes.
And Member Sue? Passes.
Thank you. Brings us to public comment for persons desiring to address the board on an item that is not on the agenda. Please note each speaker is limited to 3 minutes. The Brown Act limits the board's ability to take and/or discuss items that are not on the agenda. Therefore, such items may be referred to staff for comment or a future agenda. Seeing no one in the audience, is there anyone online? Oh, all right, that brings us to reports. Item 4-1, presentation of investment reports by CIBE Private Wealth, quarter ending December 31st, 2025. Welcome once again to the Pension Board.
Thank you, and good afternoon, everyone. My name is Rashad McKinney. I'll be presenting the investment performance review as of December 31st, 2025. It's a quarterly review, and also because it's year and quarter, I'll also give a review for the year as well. So I'll start off by discussing the asset allocation. So as at December 31st, 2025, the portfolio had 5% allocated to cash at $99.8 thousand. The fixed income portfolio was $924.4 thousand, with the Dodge & Cox Income Fund at $423 thousand and the Vanguard Short-Term Investment Grade Fund at $471 thousand. The equity portfolio portion of the portfolio stood at 50% at just a little bit over $1 million, bringing the total portfolio value to $2.033 million. What constituted the change between the previous quarter to this quarter? So there were no net additions or withdrawals between the quarters, but income generated on the portfolio was $85.6 thousand. There was a capital depreciation between the period. There was a bit of market fluctuation. So the portfolio lost $48.6 thousand. Nevertheless, there was a total return because of the outperformance of income at $36.9 thousand, bringing the market value to the $2.033 million. If we look at it from the inception, the portfolio started out in September 2009 at 10.9 million. Net additions and withdrawals from the portfolio, for the most part constituting withdrawals, payouts, stood at 15.8 million. Income generated over this period was 2.6 million. The portfolio appreciated at 4.2 million, presenting a total return of 6.9 million. And again, the market value as at the end of this quarter, 2.03 million. If we look at the performance results, what would have driven the return for the last quarter and also for the year? The total portfolio had a return year to date of 10.14 million. What really drove returns would have been the equity portion of the portfolio, which provided a return of 13.6 for the year. The fixed income portfolio also had a handsome return, even though fixed income tends to really teeter between the 6 to 4% returns. The income fund had an 8.3% return, and the Vanguard short-term investment grade fund had a return of 7.17% return. Since inception, you could see that fixed income generally produces a return of around 3.7% for the Dodge and Cost Income Fund, and the Vanguard short-term fund at 6.01%. The equity portfolio since inception has provided a return of 12.7%. Overall, from 2009, annualized, the portfolio has had a return of 7.29%. So before I move into the financial markets monitor, are there any questions? All right. So this financial markets monitor gives us a view of how the portfolio performed last year and is also forward-looking, giving us some insight onto how the portfolio should perform and what market factors would drive performance into 2026, starting with the first quarter. So as you've seen, based on your return, the equity portfolio and equity returns were pretty strong for 2025. The U.S. large cap portfolio segment had about 17.9%. International markets performed exceptionally well last year, driven for the most part by an infusion of growth in the European market and also in Asian markets. So developed international, 31.2%, emerging markets, 33.6%. The Fed would have reduced interest rates for the year, and so that provided some incentive because as interest rates go down, market values go up, and returns tend to be relatively good for the bond market. So long-term treasuries and also the intermediate government corp had returns at 5.6 and 6.9%. High yields also performed well during this period. There is some strength in that market, and there's also a low probability of default, so they tend to still provide good returns during this time. Commodities also saw really good return, in particular gold. Gold still is providing return well into 2026. Oil was a little bit negative. It continues to trend on the down end into the new year. And the commodities index, which is a blend of precious metals and other industrial metals, had a return of 15.8%. So if we move forward to the themes, this represents a list of what we're looking forward to in 2026. The One Big Beautiful Act is projected to provide some surprises in the market. It's going to provide incentives for the consumer, and the consumer represents 70% of what GDP growth comes from. So that's something that we're looking forward to. But at the same time, there were some shocks in the market last year with regard to trade and tariffs and also immigration policy. So growth in the job market was slow. It still represents a time right now when job opportunities are stiff. So that's something that we're going to look at, see how those two factors work against each other, and if it leads toward growth in the U.S. economy overall. Prices and inflation continue to trend downward, which is a good sign. The path remains contentious, and we'll speak about that a little bit later. There are some members of the Fed board that disagree. Nevertheless, interest rates and the rate was decreased last year, so that's a good sign. With the Fed and fiscal policy tailwinds, so there's kind of a disagreement between what's coming out of Congress versus what the Fed is doing. That's something we're going to continue to look into to see how that drives the growth in the economy and also how that affects inflation. And we're going to also continue to look into how equity markets will be driven by the boom in AI AI provided a significant boom in the markets, but it's something that's considered short-term, so the market doesn't want to depend on it for too long because it's not sustainable. So if we look at the U.S. economy, we can see here on the graphs to the right that growth was slow. The U.S. market did exceptionally well, but overall growth in the U.S. was slow. So it's important to look at the factors that really show how the economy is performing. In addition to that, inflation is on the downtrend. You would remember in 2022, inflation stood somewhere north of about 4 or 5%. So now we see it on the downtrend towards between 4 and 3%. So that's a good sign. And other things that we have to take into consideration, again, the One Big Beautiful Bill Act, we think it's going to provide some surprises within the market. Individuals are going to receive incentives to spend, and it's going to continue to churn growth in the economy, so that's a good sign. Again, the Fed is going to decrease rates this year as they projected, and we also think that there may be incentives for business owners who might have been affected early on last year with tariffs. If they receive those incentives, it will be a boost and stimulus for those businesses to do well as well. So we continue to look and watch and monitor that. Again, AI investment, although we think it's going to be temporary, still represents a good opportunity for growth in the U.S. market. So we look to that as well, and we hope that it would result in growth in the portfolio. The housing market is seeing hints and signs of growth. I'm sure with us being in the Bay Area, we can see that now. There are a lot more homes for sale. The Bay Area tends to lead growth, be a leader in terms of growth in the housing market, and also lags in terms of the slowdown of growth in the housing market. So that's something to look at. This graph, I think, looks very dramatic, but the reality is the 30-year mortgage rate has not changed really much between 2024 and 2025. Yes, it was somewhere north of almost 7% briefly, but now it's still above 6%. So not really much of an incentive for those who know what the history of mortgage rates look like to buy, but it's a good sign for those maybe who want to purchase their first home that it's a little bit more affordable now and they may dive in. In addition to that, Fannie Mae and Freddie Mac, institutions that tend to securitize mortgage loans, when they purchase mortgages, they also provide a level of demand for mortgages, and that tends to put some pressure on rates as well. We see that there's been an uptick in that. Hopefully that continues within the new year, and we'll see that the housing market will provide another sign for growth. And then we look at markets, and for the next two slides, you will see questions about a bubble. I was at a conference about 2 weeks ago with some other individuals who are wealth managers, and the question was asked, are we in a bubble? And I'm sure most of you here today can remember the dot-com bubble. Every commercial was followed by dot-com. Everything was really leading individuals to the fact that they were launching a website, and that what shortly followed after that was a crash. We could see something similar to that today. We drive down to the San Francisco Bay Area, every flyer, every banner as you go towards the airport, AI, AI, AI. And it does lead you to be concerned because there are some similarities. But while there are similarities, the fundamentals are still very different. The market is very concentrated in AI stocks and companies that are invested in AI, but the numbers still show that these companies are showing growth in their earnings, which is the #1 driver for market values. So the growth is still there, earnings are there, these aren't fake numbers. The companies are doing well. Nevertheless, these companies are pricing future and anticipated revenue into their markets, and I think that's what's providing an additional incentive for individuals to buy and invest in these companies. So that's something that we definitely need to look out for as we move into the future. And again, we speak about the Fed Reserve, and I think this is an interesting graph we have here. In particular, if you look at the dots towards the right, it shows how the 19 FOMC committee members are voting. So we can see that it's really heavily tilted towards individuals voting for higher inflation rates and not really pushing it down to a lower rate. So that's something that we want to make sure that we continue to monitor. There is some dissension within the FOMC committee. I'm sure we see what's happening with the current chairman right now. He's currently under investigation. So there may be some shakeup there. However, we can see that for the most part, the committee is leaning heavily towards keeping it expansive, but not too expansive. So there's going to be incentive for inflation to be decreased, but the rate at which that happens is going to be slow and moderate. So that's something that we continue to look out for, and hopefully we see that continue to trend down well into 2027. Again, cash. Cash is something a lot of individuals and organizations don't really think about. They just want to know how they're invested in bonds, how they're invested in equity. But cash is now the new investment class. How you're invested in cash could determine how your portfolio does, especially if equity does not do well. So we see here in this graph, money market assets climb while yields fall. Money market assets continue to be a very healthy asset class for investments because T-bills at one point in time were relatively high, but now it's going down. So this is something that's going to be important even for how we manage your portfolio. Make sure that cash is invested or it's in a money market, vehicle, so that it's not just not gaining any interest rate. But that's something that we want to consider as we move forward into 2026. And then we see here U.S. equities. This really speaks about the bubble and valuations. The market is high. Some would even say the market is fully valued. If we look at the metrics and the percentiles, everything is almost north of 90%, 95%. This shows that this market is significantly highly valued. It's expensive. There are hard to find opportunities for growth and expansion. And what this also means is that there is a lot of competition between managers to provide outperformance for their clients. And it also shows that these rates are not sustainable. Realistically, we should see a forward PE that's somewhere close to maybe 15 times. And right now it's at 22 times, and the big performers are north of 30 times. So you want to continue to monitor that and make sure that, of course, you're benefiting from those companies that are doing well, but when the market does pull back, we don't want to have an overexposure to that. And again, as I would have mentioned before about active management, active managers are having a tough time. The market is showing that stocks that should not perform well are performing well. It is encouraging active managers to provide concentration within portfolios, which is an absolute no-no when it comes to portfolio management, but this is what's driving growth. So I think this is a very interesting slide probably to review on your spare time, just to show you, how things are doing in the market and where there's competition. And again, if we look at international equities, the two graphs on the right show that the factors that continue to provide growth or incentives for growth in the international market. There was a time when quality was the number one factor. If we think of quality, we think of the fundamentals, earnings, how sustainable those earnings are for a certain period of time. And that really was the number one driver for valuations. But things have changed now. We see the quality is actually down the bottom of the list right before minimum volatility. So again, times are changing. Managers are having a tough time. Nevertheless, these particular segments in the market are providing significant sources for return and are doing well. So it's something that we want to continue to monitor and consider. The portfolio that you guys have just have a small allocation to equity. This private credit slide, I'll skip over this because it doesn't really apply. There's no private credit in the portfolio. So again, if we just do an overview, U.S. equities continue to do well. There's expected expansion well into 2026. Trade policy is an important thing, but we believe that between the Supreme Court and the incentives that it may provide for companies that probably paid high tariffs in 2025, that would be a good thing. International developed equities, again, we expect that they would continue to do well. Emerging markets as well. A lot of countries and certain sectors are seeing easing, in particular China. China's growth and easing has provided some incentive for their individuals who drive the growth in terms of their GDP, so that's something to look out for. Fixed income, the interest rate is trending downward. downward trending shows that there will be growth within this segment. We're going to see a good return, so that's a good sign. And if we look at real assets and alternatives, for the most part, everything here remains the same as it has remained for the past few quarters, except for energy. Coming into the president's tenure, a lot of individuals were afraid that clean energy would not do well because it's not something that this current president is fond of. However, with the One Big Beautiful Bill Act and new tax bills coming into effect in 2026, there are incentives for having clean energy renewals and storage facilities, and also the use of AI. So that's something to look forward to. We're already seeing that new clean energy is performing well for the year. It did a really good job today, as a matter of fact. For real estate, office valuations still remain low. There's still elevated vacancy rates, so that's an area that we want to continue to look out for. Infrastructure, however, has always been a good area of performance in the real estate or the real asset segment. And again, alternatives, not really a factor for this particular portfolio, but it provides that balance between the equity and the bond portfolio. So these managers in the alternative space, they are seeing opportunities. Hedge funds did not do well, I would say, for the last 15 years, but they started to trend upwards. So that's a good sign for that segment. It shows that individuals are finding pockets of return and growth, and the alternative segment is where it's at. And that will sum up the return on the portfolio. If anyone has any questions, happy to answer those.
Are there any questions? Thank you very much for your report.
Thank you.
And that takes us to item number 5, discussion and possible action item on matters related to the following items. 5-1, organization of officers. Staff recommendation to select a chair and a secretary for the pension board. Okay, I'll say it. I'm happy to do it if either of you two want to. And we need a secretary, and I would nominate Ann.
I'll volunteer myself.
Okay, so
So I'll move
Thank you.
Member McQuaid to be the chair for 2026, and Member Sue as the secretary to the pension board.
I'll second. Any discussion? Did we get a roll call, please?
And there's no public
There's no public.
around. Member Curlin? Alternate Murphy?
Yes.
Member alternate?
Yes.
Yes?
Yes. Yes.
Motion passes.
All right, for announcements, staff board members, announcements and requests for future agenda items. Before I do this, I'm sorry, I want to go back for a minute to 4. The recommendation was simply note and file. So we didn't need to take a vote on that. Okay, so any announcements? James, do you have anything?
No.
Okay. The only thing, and I think it's just to think about for the future, not to take action today, is if this 3 o'clock is the best time for everybody to meet, if that works best for our consultants and if it works best for y'all. We used to meet in the morning and it got changed, and I'm just always curious if this is the best time.
Not sure. It's always been this time as long as I've been on this board, so I didn't know that it used to be the morning.
Yeah, so I don't want to get in trouble for taking action on something that's not on the agenda, so maybe it just goes away. And with that, we can adjourn, right?
Yes.
Okay,
3:25.
3:25. Great, thank you all.